Applied Materials' whole growth story is now riding on DRAM and high bandwidth memory, while flash and foundry-logic mix both slipped this quarter. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Applied Materials gets graded and traded. So on the headline, revenue came in about 1.2% above what analysts expected. That's a modest beat on the surprise line. But the real story is that this is record revenue for the company, so they cleared the bar cleanly on the biggest print they've ever put up. And on the earnings side, they came in about 3% above what analysts expected. EPS is what Wall Street grades a company on, so beating the number on a record revenue quarter gets attention right away. So on the beat itself, a 1% revenue beat and a 3% earnings beat are both real, but they're small in absolute terms. That earns a C. Clean beats on both lines, just not the kind of blowout that reprices the story on its own. On consistency, this company has been beating quarter after quarter with real reliability, so this earns an A. When management guides and then delivers this consistently, the market starts trusting the next guide too. Let's talk about the positives from the report. They just put up the biggest revenue quarter in company history, $9.12 billion, up 25% from last year. For a mature equipment maker at this scale, a 25% growth number is huge. It tells you the AI build-out is showing up directly in what they're selling. Their non-GAAP gross margin, which is basically how much profit they keep out of every dollar of sales before overhead, expanded about 1.5 percentage points to 50.4%. And this is the 13th quarter in a row they've grown that margin year over year. 13 straight quarters of margin expansion means they're not just selling more, they're keeping more of every dollar. That's real pricing power. Their semiconductor systems business, which is the main event, grew 27% year over year, and its operating margin jumped almost 5 percentage points to 38%. This is the segment that sells the machines that make DRAM and high bandwidth memory chips for AI. When both revenue and margin move up together like this, it's called operating leverage, meaning each extra dollar of sales turns into even more profit. They generated a record $3 billion in cash from operations this quarter, and sent $860 million back to shareholders through buybacks and dividends. Cash from operations is the money the business actually pulls in from doing its job, before any accounting adjustments. When that number is a record and they're still returning cash to shareholders, it means the business is genuinely printing money right now. And this is the one I keep coming back to. They guided next quarter to $10.25 billion in revenue, which implies about 40% year-over-year growth at the midpoint. And management said 2027 is going to be another strong growth year on top of that. A 40% growth guide from a company this size is a wildly aggressive bar to set, and the fact that they're setting it tells you they have real visibility into orders through next year. So on profitability, this earns an A. 13 straight quarters of margin expansion, record cash generation, and operating margin jumping almost 5 percentage points in the main segment. That's about as clean as a profitability picture gets. Now, let's talk about the negatives from the report. Their interest and other income line swung about $500 million in the wrong direction compared to last year. Most of that came from losses on some investments they hold, versus gains on the same line last year. This doesn't hit the clean operating numbers, but it's a real dent in the reported bottom line that a lot of people won't notice. Their growth is getting concentrated in one place: DRAM and high bandwidth memory chips. At the same time, flash memory mix slipped and foundry-logic mix also ticked down. This matters because when the whole growth story rides on one demand cycle, any slowdown in that specific cycle hits them a lot harder than if the business were more spread out. Their receivables, which is money customers owe them but haven't paid yet, ballooned by about $2.5 billion over the last 9 months. When receivables grow this fast, It usually means they're booking sales faster than customers are actually paying them. That can catch up to cash flow later if customers slow down on payments. Their other segment, which includes the display business, posted an operating loss of $118 million this quarter compared to basically break even last year. That's a real chunk of money going the wrong way, and it drags on the consolidated numbers, even though revenue in that segment barely moved. Their capital expenditures, which is spending on equipment and facilities, ran $700 million this quarter, up 21% from last year, and management flagged more capacity investments coming through the end of the decade. This matters because when CapEx ramps up like this, the cash left over for shareholders can lag the reported earnings growth for a while. On guidance, this earns an A. They raised the full year outlook for their main segment, guided next quarter to about 40% growth, and said 2027 is going to be another strong growth year. When management pushes visibility that far out with real numbers, that's the top of the range on guidance. And on red flags, I'm at a C. The receivables build is the one I can't fully dismiss, and the growth concentrating in DRAM and high bandwidth memory means any air pocket in that specific cycle hits them harder than a more diversified equipment maker. Putting it all together, this was a genuinely exceptional quarter. Record revenue, record cash, 13 straight quarters of margin expansion, and a forward guide that pushes visibility all the way into 2027. The concerns are real, but manageable. Concentration in DRAM and a working capital build worth watching. Overall, I'm giving this print a B. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. The earnings support me getting in, but that fourth quarter guidance of $10.25 billion plus or minus $500 million is a pretty high bar, and I know this thing is going to gap on the print. So instead of chasing shares at the open, I like selling cash secured puts into that pumped up implied volatility right after the report. I'd target strikes at technical support somewhere around 8 to 12% below the post-print price, using 30 to 45 days to expiration, so I capture that premium before it fully compresses. That's why my plan is to sell puts into the volatility. My strike floor has to be a level where I'd genuinely be happy taking assignment, especially with that raised full year 2026 outlook and the growth they're calling out into 2027. This release really cuts down the odds of a nasty downside guidance surprise in the next 90 days, so I feel better sitting closer to the action. If I actually want the shares, I'll pull my strike ceiling closer to the money, because sitting way out of the money leaves too much premium on the table now that demand visibility has structurally improved. So I'm striking where I'd actually accept the shares. I'm holding with conviction here, and honestly, I'm looking to add on any post-print weakness because the raised calendar 2026 semiconductor systems outlook makes the ownership case stronger, not weaker. The 27% semiconductor systems revenue growth and the extension of visibility all the way into 2027 tells me the AI CapEx story is real, with actual numbers behind it. The only reason I'd trim is if my position got too big for the portfolio, not because anything in the thesis broke. My move is to hold and add on any weakness. That aggressive fourth quarter guide, which is somewhere around 40% year-over-year revenue growth at the midpoint, tells me I do not want to let near-the-money calls just get assigned away. The commentary about another strong growth year in 2027 really argues for continued upside momentum from here. If I wrote calls before the print at strikes that now look tight, I'm closing them early and rewriting further out of the money at longer duration to keep my upside without losing premium capture. I'm rolling them up and out. I'm holding my long-dated calls and looking at rolling them up and out to capture that extended demand visibility running through 2027. Management is talking about manufacturing capacity investments through the end of the decade, and that directly supports my 12 to 24-month thesis on these long-dated calls. Taking some partial profits on my deep in-the-money long-dated calls and rolling into higher strikes at longer duration feels like a reasonable rebalance, given how far the story has stretched out. So I'm rolling them up and out through 2027. This release validates my original thesis instead of breaking it, with record revenue, 41% EPS growth, a raised full-year outlook, and visibility extended into 2027. I'm adding in pieces on any post-print weakness, and I'm prioritizing zones where implied volatility is still elevated, so I'm getting paid for the entry. The one risk I'm watching is the concentration in DRAM and high bandwidth memory, so I size each ad small enough that an air pocket there couldn't force me out. My plan is to average down in pieces. Bottom line, this print earns a B from me. Record numbers across the board, a raised outlook, and demand visibility extending into 2027. The AI CapEx story is showing up directly in what they're selling. Thanks for watching, and I'll see you on the next one.